Welcome to this class in which we want to talk about budgets and more specifically the preparation of the master budget. So we will first of all look at budgets within the context of the organization, and this means that we have a system of budgets which lead to controls and objectives. Now, a budget provides a comprehensive financial review of planned company operations. It's a statement that sets out the financial overview. It reviews its activities. It distills all of the various feedbacks and reviews. It forms budgets, and it enters those budgets into the planning framework for the company. Now, what are the benefits of budgets? Well, they compel the manager or the managers to think ahead. Budgets are forward-looking. The managers know what they have to spend over the coming time period, so they must think carefully about the road ahead. They also provide an opportunity to re-evaluate existing activities and evaluate new ones. So budgets constantly keep in front of the managers, virtually all levels of management at in different ways, but nearly all levels of management are forced to look ahead, to think about where they're going and how they do things and how the operations are run and so on. And budgets aid managers in communicating objectives and coordinating actions across the organization. So they're generally useful forward-looking tools. Budgets, of course, not only are financial, but they relate to humans as well. Low levels of participation in the budget process can lead to a sort of alienation amongst the workforce. They're not engaged with the process, so perhaps human resource problems can partially be resolved by integrating the views of a wide spectrum of stakeholders, workers, shareholders, managers, and all who were involved in that sort of business at that level. And there's also, of course, the problems of acceptance of responsibility for the final budget. Once it's agreed, who is it agreed by and who signs it off? Who puts their name to it? If it goes wrong, this is a major problem. When preparation of the budgets, of course, there's always an incentive to lie and to cheat. Budget centres, managers who hold budgets, always have an incentive to inflate their estimates of what they require and try to build little empires for themselves around their own budget. So there's always an issue of getting the truth and integrating the truth into the final master budget. There's also a problem, of course, of getting final sales forecasts or accurate sales forecasts. The future is difficult to predict, and the marketing department may not be in possession of all the information necessary to make accurate long-term forecasts. So there's a question mark about the resources that's going to be needed in the future in that context. Ideally, in the preparation of the master budget, there should be a two-way flow of information. There should be a more collaborative approach so that better and more accurate figures are entered into the budget. The cost centres are clearly defined. Responsibilities for the budgets, the individual budgets, are allocated, and there's more information about, which it'll have a human resource element in the sense it'll create more engagement. The workers will be more involved in the day-to-day running and participation in the business. Now, the problems in implementing the budgets, well, participative budgets are formulated with the active participation of all affected employees. So the people who are affected by the budgets somehow should be either consulted or integrated into that planning framework to get their opinions and their views, their comments about existing practices and what's likely to happen in the future and so on. So as I said, a more informed budget can be drawn up. The message conveyed by the budget system may be misaligned with incentives provided by the compensation system. So generally, what's required here is that all parts of the business are singing from the same hymn sheet, to use an expression. All parts of the business are, they mesh, they are all synchronized, they are saying the same thing. It would be wrong for the budget system to be aiming at a particular outcome when policies in other sections are going in a different direction. So there must be some sort of commonality in the view between the various budget heads, budget centres, between the centre itself, the business centre with the senior management. Everyone should be pointing in the same direction, and the budgets should enable this to happen, should give a clear picture of the direction. Now, on the incentives to lie and to cheat, well, when the incentives are not clearly stated and when there is ambiguity in the budgets, then managers tend to make poor decisions and also feed in perhaps poor quality information. Lying can arise if the budget process creates the incentive to bias the budget information. A budget centre, a budget holder, may lie if he or she thinks that the information is not there to contradict them. They may exaggerate what they require in terms of capital, technology, manpower, whatever. Ultimately, that will make their life easier, but it will be inefficient for the business. And so-called budgetary slack, budget padding, is an overstatement or understatement of budgeted revenues to create a goal that is easier to achieve. So when the various parties to the budget make their submissions so that the final master budget can be drawn up, they may bend the figures in a way that makes their life easier, and that therefore they will be seen to achieve their objective. But the objective they set themselves, of course, is not an accurate one. It's not the most efficient one. Sales forecasting. Well, a sales forecast is a prediction of sales under a set of conditions. That's all it is. The sales forecasts are usually prepared under the direction of the top sales executive. The sales budget is the result of decisions to create conditions that will generate a desired level of sales. A sales forecast is just a forecast, and it suffers, like all forecasts, from the possibility of unknown events in the future knocking it off course. The future is not easily predicted, so sales forecasting it's an art probably more than a science. Now, factors to consider when forecasting sales. Well, Market research studies, that's any source of information, providing it's reliable and collected correctly. Past patterns of sales might be an indication. So when the final master budget is drawn up, the past pattern of sales might be looked at to see if the current budgeted set of sales are realistic. The sales team themselves, who know the customers and know the market, may be able to submit proposals and figures and ideas that will update the likely future forecasts. The general economic condition of the country, macroeconomics will feed in. What is the current rate of inflation? What's the level of unemployment? What is the exchange rate? What's the interest rate? So all sorts of figures may be taken into account, and maybe it's the case that the skills to analyse those figures are not within the company, but perhaps outside expert opinion might be sought. Competitors have to be taken into account. Competitors are not passive. They don't sit around just letting everything happen. They're doing things themselves. They're involved. They're engaged in the process of out-competing the business. So their actions have to be taken into account. Changes in prices are always a problem. So that might be an issue. It might alienate the customers. It might create uncertainty in the market. But prices sometimes have to be changed. There's no alternative. Changing the product mix, changing the way production is configured so that there's perhaps a wider variety of products placed on the market. That might be a possibility. It might make planning more difficult, but it might be the route forward. And of course, advertising and sales planning. That's again, there's an unknown here. The fact that somebody engages in an effective marketing campaign, it's effective, it's successful, but it may not be as successful as projected in the budgets. So some sort of benchmarking or criteria may have to be set down against campaigns to see if it meets what was expected. Now, the types of budget. Well, there's the master budget, which is really what we're talking about at the moment. But of course, there's a lot feeding into it. There's the strategic plan. What do the managers think is the ideal course of direction for the business? What products should be sold, which markets, what prices, and so on. There's long-term planning. Where should production take place? What sort of machinery, what sort of capital, what sort of research and development, what sort of product range is envisaged in the future. There's continuous budgets as well. Day to day, they have to run the business, so there must be some referral to a budget for whatever it is that's purchased to make sure that expenditure is under control. And of course the capital budget, which is really the investment in the future, investment in new plant, new machinery, research and development, whatever it is. And there must be a budget to enable this to happen as well. So there are various types of budget, all of which feed into the master budget. Let's look at the strategic plan. As the most forward-looking budget is this one, the strategic plan. It sets overall goals and objectives for the organisation. It sets out where it's going and some idea of how it's going to get there. It's a long-term planning statement. It provides forecasted financial statements, usually for a long period, 5, maybe 10 years, long periods. But strategically, that's where the business is going, that's the objective, that's the plan, that's what people are aimed at. It gives direction to the course of the business. The long-term plans, well, long-term plans are coordinated with capital budgets, which details the planning expenditures, or the planned expenditures, I should say, for facilities, equipment, new products, long-term investments. So long-term plans go with the capital budget. The master budget links to both long-term plans and short-term budgets. The master budget is, as the name suggests, it is the budget that holds the other budgets, so everything feeds into it. Right, let's go on and have a brief look at the master budget. It's detailed and comprehensive, and it covers a wide range, a long range of time, perhaps from 1 year onwards. It summarizes the planned activities of the subunits of the organization, so it takes in all of the various departments, their budgets, their expenditures, the overhead budgets, marketing. It takes in research and development, product development. It takes in lots of the budgets, integrates all of them into the master budget, so one document contains the picture of the direction of the business. So sales, for example, would be built in, production would come in, and distribution, and the finance for all of this, of course, would be incorporated. Really, the master budget captures all of this in financial terms, so that the importance of different items is measured against the financial figure. Now, the contiguous budgets, well, these are sometimes known as rolling budgets. They're a common form of master budgets that add a month in the future as the month just ended is dropped. So let's say we have a 12-month rolling budget, and it starts in January, ends in December. Well, as we move into the following January, then the first January is dropped. So it's always 12 months. As time moves on, the budget remains 12 months, but just the new month coming in is added, and the first month in the budget, 12 months earlier, is dropped out. If you have a look at that, it's just here's a year, January to say December. And as January comes in, I'll just put the cursor on the screen, as this January here enters, the first January is dropped. So it's still 12 months and it's still rolling on. As they go into the next year, February comes in and the first February here drops out. So that's the idea of a rolling budget. It over time, it keeps the same time periods rolling, but it's continuously updated. Now, the steps in preparing the master budget. Well, first of all, you need some basic data, and then we need the operational budgets and the financial budgets to see what's programmed and how the current position of the company fares in financial terms. So 3 main components just to get the ball rolling. So if we start with the operating budget, that's the profit plan. It focuses on the income statement and supporting schedules of budgeted expenses. So the operating budget is really an income statement. The financial budget, well, it focuses on the effects that the operating budget and other planned budgets will have on the cash balances. So the financial budget looks at the operating budgets and the other plans that the company have and see how they will affect cash balances. So we have 2 big statements there. Now, the three principal steps in preparing the master budget. Well, these are as follows. These are step one, the basic data. Like I said earlier, the basic data is the starting point, and this can be broken down into subsections: the sales budget, cash collections from customers, purchases of and costs of goods sold on the budget, cash disbursements for purchases, operating expenses budget. So it's all the basic data: cash disbursements for operating expenses. So yeah, it's all the data, all the basic data that you'd expect. Now, step two, the operating budget. As I said earlier, these three components are necessary in the preparation of the master budget. And the operating budget prepared budgeted income statements using the basic data. So you take the basic data and form it into the operating budget. So that's where that one runs to. And the financial budget, you prepare forecasted financial statements. These are from the capital budget, what's likely to be invested in the future, the cash budget, how the company is doing currently and likely to do in the short to medium term, and the budgeted balance sheet, what's likely to happen in the future. And these three are then, and the three steps are then put together to form the master budget. Now, the operating budget, well, you have the sales budget, that's cash collected from customers, and purchases budget, which comes from the sales, and the disbursements for purchases, the amount that's given out to pay for the purchases. And out of these you get the operating budget, which are the disbursements for operating expenses. So the operating budget fits in, it's another aspect of feeding into the master budget. Cash collections, well, it's easier to prepare budgeted cash collections at the same time as the sales budget. That's the two things run in parallel. The cash collections include the current month's cash sales plus the previous month's cash sales. Now, the purchase budget and cash disbursements, well, budgeted purchases equals desired ending inventory plus cost of goods sold minus beginning inventory. And that's the equation. It's what you budgeted equals your desired inventory at the end, what do you want in stock at the end, plus the cost of the goods you bought minus the amount you started with. There are different ways of looking at this, but you could, or it is possible, I should say, to take disbursements to include 50% of the current month's purchases and 50% of the previous month's. It sort of averages it out a bit better, just in case there are exceptional items in any one given month. Operating expense budget. Well, the budgeting of operating expenses depends on several factors. Month-to-month changes in sales volume and other cost driver activities directly influence many operating expenses. Operating expenses, it can vary, but there can be unknowns even, changes in the environment or changes in costs that were not anticipated. So things happen, and the brunt of these things happen on the operating expense budget. This is the one that suffers most. Expenses driven by sales volume include sales commission and many deliverable expenses. These can be easily commissioned and written into the master budget or into the operating expenses budget. When they're programmed in that way, that's okay. But changes in the environment which impact on the operating budget, these are totally exceptional and a real problem. Other expenses not influenced by sales or other cost driver activities are regarded as fixed, within relevant ranges, of course. So some expenses are just locked down. They don't vary as output varies or as production varies. Rent, for example, on the premises. It's an operating expense, but nothing you can do about it. It's a fixed. Depreciation, if you've got the machines, they depreciate over time. I agree it may depend on the intensity of their use, but even if they're not used, machines just get old. Technology moves on and the depreciation for these must be written off and accounted for. The place might have to be insured against fire or theft or whatever, and that's normally a fixed cost. And many salaries, it's not easy to hire and fire people. Many salaries are fixed. It doesn't matter how much is being produced. The people are still in place. So operating expense disbursements. Well, disbursements for operating expenses are based on operating expenses budget. The total of these disbursements is then used in preparing the cash budget. So you work out what the operating expense budget is, you work out what's allowed for expenses, and they then enter into the cash budget to say that's what's likely to be the outcome of this activity, and this is the impact on cash flow or on the short term to medium term profitability of the business even. Income statements will be complete after the addition of interest expenses, which is computed after the cash budget has been prepared. So the income statement needs to, it's the other side of the coin. It's what is coming in from the sale of goods, and it may include interest payments payable by the banks for monies flowing in. Budgeted income from operations is often a benchmark for judging management performance. It's one of the reasons why I suppose people want to lie. We talked about earlier. If the budget holders can play down the likely future income stream, then when it's above what they have suggested, of course they look really good. They look really like they've done a very, very good job, and credit is given to them. In fact, had the truth been told at the start, this is what would have been expected anyway. The cash budget is statement planned cash receipts and disbursements, so it's cash flow. It's the available cash balance, the net receipts and disbursements, and financing. So it shows that the business is able to pay its bills whilst at the same time making investment decisions, generating profits, looking after markets, looking after its people, and so on. It's able to pay day-to-day expenses. The cash budget, it's the available cash equals the beginning cash balance minus the minimum cash balance desired. So it's what is required. And the cash flow statement is probably the best example of this type of budget, or it can be generated from this type of budget. Cash receipts depend on collection from customers' accounts receivable, cash sales, and other operating income sources. There's also an element of credit terms that need to be entered in. This is a refinement, but many sales might be on credit terms, and that needs to be built into the cash budget, because even though the sale took place, the revenue has not been received. So there may be implications again for cash flow. Payroll depends on wage, salary and commission terms on the payroll dates, and generally speaking that's fairly fixed. Salaries are certainly fixed. Managers within specific departments are implied irrespective almost of the scale of the operation. The marketing manager will be there whether the business is very big or just big. If it's small, he might have a problem, or she might have a problem. Cash budget again. Well, disbursements for some costs and expenses depend on contractual terms for installment payments, mortgage payments, rents, leases, and so on. So some costs, there may be an agreement, a legal agreement to make certain disbursements at certain time periods. Again, a cash flow issue, and it needs to be shown that the company can meet its obligations. Other disbursements include outlays for fixed assets, long-term investments, dividends, and so on. Management determines the minimum cash balance desired depending on the nature of the business and the credit arrangements. That's the bottom line. That's what is absolutely essential. That's the amount that must be maintained. Financing requirements depends on how the cash is available compared with the total cash needs, which is, as I said, is a function of sales, the credit arrangements, how soon the cash can be received from the sales, the programmed expenditures that we talked about, rent, the contractual arrangements for leasing machinery or payments of all types which are contracted. And all of this leads to this single document, this cash flow statement, which can generate the cash budget. This is the amount that the individual budget centres can spend in the time period specified. The ending cash balance is equal to the beginning cash balance plus receipts minus disbursements plus cash from financing. And the cash from financing can be either positive, an inflow, or negative, an outflow. Next, the budgeted balance sheet. Well, the final step in preparing the master budget is to construct the budgeted balance sheet that projects each balance sheet item in accordance with the business plan. Essentially, all of the various parts, all of the various budgets now are ready, and all of the factors, including factors we haven't discussed perhaps, all of those factors are now going to feed into the master plan. And the budgeted balance sheet takes all of the summary headings, adds them all up, and produces a master balance sheet. The management then considers all the major financial statements as a basis for changing the course of events. Activity-based master budgets. Well, functional budgeting focuses on preparing budgets for various functions such as production, selling, and administrative support. Activity-based budgetary system emphasizes the planning and control purposes of cost management. It's the costs of the activities. So the functional budgets looks at the overall functions such as production or selling or administrative support, whereas activities tend to, or could be, moved down to individual items produced or individual parts of the organization. So activity-based master budgeting is more detailed. Financial planning models are mathematical models that can incorporate the effects of alternative assumptions about sales, costs, or the product mix. They're only as good as the assumptions, and it's always worth remembering that. And even the data that goes into them may not be as pure and accurate and as error-free as we'd like to think. Also, they're working in a wider planning framework, the wider environment, where many factors are in play, social, economic, political, and so on. So that also is an issue. And those sort of models are based on assumptions, and the assumptions can be wrong. So there is an issue there. Spreadsheets are often used for this activity, and there are many commercial packages that are available to try and help mostly SMEs, small to medium-sized enterprises, or growing enterprises to sort out the budgeting arrangements. So there are many packages available on the market. The nice thing with spreadsheets is, of course, arithmetic errors are virtually non-existent. People do not add up the wrong columns or whatever, because if it's programmed correctly, it tends to be error-free on the arithmetic front, at least. I think what you get from this talk is the complexity of the budgeting process. At one level, we have the master budget, which is the overall view of the business, but that is composed of subsidiary budgets, and each one of those have got errors and problems and inaccuracies, and the management are trying to refine the data, and there are unknowns, there are assumptions about the behavior of the creditors and the debtors, and it's all happening within an environment which is outside the control of the business, the political, economic, the social environment. So all of the subsidiary budgets feed into the master budget. And that's how the process works, and that's how the planning framework for fairly large companies operates. Thank you for watching.